The huge share market bounce captured all the attention, of course, but the most important action was in the bond market. The 10-year US Treasury yield spiked to 4.5% yesterday and stayed there. That might not seem a big increase, but the last time it went up that much in 3 days was 1982. Why is it such a big deal? Well, because the US government is $36 trillion in debt, and the bond market is where that debt is bought and sold. If investors and other countries lose confidence in US government debt, then, well, no one really knows what then, because it's never happened, and no one wants to find out.
On May 9th, 2025, something happened in Washington that didn't make front-page headlines, but should have. The US government tried to sell long-term debt, a routine event that usually passes without much attention. This time it didn't go as planned. A 30-year Treasury bond auction, one that normally signals confidence in America's financial future, ended in failure. Foreign investors, who usually snap up these bonds to park their reserves, barely showed up. Only 59% of the bonds were bought by international buyers. That's a steep drop from the usual. For a government that runs on borrowed money, this kind of cold shoulder is more than just a red flag. It's an earthquake under the surface. Washington needs to borrow constantly to keep the engine running. That borrowing happens through bond sales. The US prints promises, IOUs that say we'll pay you back with interest. And the world usually lines up to buy. Japan, China, and other nations have long seen US debt as safe and stable. But now even the loyal ones are backing away. That's not a theoretical concern. The national debt is already at $36.8 trillion, and this year alone, the interest bill will cross $1 trillion. That's just to service the debt, not reduce it. And as confidence in US bonds fades, interest rates on those bonds climb. Investors want to be compensated for what they increasingly see as a risk. At the May auction, the US had to offer 4.82% to attract buyers, higher than anyone expected. When demand is low, you have to sweeten the deal. But there's a cost. The more interest you promise, the more debt you rack up just trying to pay the interest. It's a vicious cycle, a debt spiral, and America is in it. Japan's move wasn't subtle either. In March, Tokyo quietly dumped $20 billion in US treasuries, the biggest sell-off since 2016. Japan, America's top foreign bondholder, has always been steady, even when China and others started pulling back. But now even Tokyo is choosing self-preservation. With a weak yen and domestic troubles, Japanese investors are bringing their money home. That should worry everyone in Washington. Because the question now is, who's next? China? Saudi Arabia? Germany? What happens if more of America's creditors decide it's time to cash out? This bond auction wasn't just a market blip. It was a warning, a message that the rest of the world is starting to question whether the US can continue to borrow forever. And without cheap credit, the American financial machine begins to slow down. It's not like the government has been conservative with spending either. Military budgets have crossed $1 trillion. New subsidies for semiconductors, electric vehicles, and domestic manufacturing, over $300 billion. But revenues aren't keeping up. Tariffs, energy shocks, and weak exports are slashing corporate profits. Last year's deficit hit a record $2.3 trillion. This year could be worse. In the middle of this quiet financial crisis, President Trump made a move that raised eyebrows. Just days before a scheduled meeting with Chinese officials in Switzerland, he reversed course on his trade war stance. In an abrupt shift, Trump announced that tariffs on Chinese goods, which had been raised to 145%, would be slashed to 80%. There was no detailed plan, no grand negotiation, just a vague announcement. Treasury Secretary Scott Bessent was dispatched to manage the fallout and re-establish some sort of diplomatic footing. The markets were caught off guard. So were many in the administration. To outside observers, it looked less like strategy and more like desperation, a sudden pivot that aimed to calm investors before things spiraled further. Beijing, notably, said nothing. No press conference, no demands, no retaliation, just silence. And silence in diplomacy can be louder than any speech. China's lack of reaction told a story, that it didn't feel the need to respond, that the balance of power had shifted. Over the last year, the US has tried to reduce dependence on Chinese imports through tariffs and reshoring initiatives. But in reality, China has quietly built new channels. In early 2025, exports from China to the US dropped 21%, but overall exports rose 8.1%. How? Southeast Asia, Europe, Africa. China's global partnerships are growing. The Belt and Road Initiative, once viewed as an ambitious infrastructure project, is now a network of trade routes. Chinese goods flow through Vietnam, Malaysia, and Thailand before reaching the US. They're repackaged, relabeled, and shipped. Technically no longer made in China, but the origin remains the same. This tactic is called transshipment, and it's working. Vietnam's exports to the US jumped 34% in April, but a significant portion of those goods are made from Chinese parts. Experts say nearly 40% of all Southeast Asian exports to the US still include Chinese components. So even with tariffs, Chinese supply chains remain intact, just more expensive. Meanwhile, inflation remains sticky. Consumers feel the pinch. And the root cause, complex global trade routes and costly tariffs, isn't going away. At the Geneva meeting, U.S. negotiators pushed for rare earth supplies and looser trade restrictions, but the reception was cold. Many emerging economies, once eager to work with the U.S., are shifting toward Beijing. They're not just buying Chinese products, they're adopting Chinese payment systems. The digital yuan is spreading across Asia, Africa, and the Middle East. Deals are being settled outside of SWIFT, away from the dollar. This isn't just economic maneuvering, it's a geopolitical shift, a quiet rebellion against the financial world the US built, and one it assumed it would always lead. In this changing world, the US finds itself at a crossroads. Bond sales are faltering, allies are hedging, rivals are rising, and inside Washington, panic is setting in. The bond auction was just the beginning. As the US scrambles to hold on to its financial credibility, a larger threat is taking shape, not just from abroad, but from within the very foundation of its economy, the dollar itself. Treasury Secretary Scott Bessant's emergency trip to Geneva didn't go well. He was there to reassure partners, calm investors, and secure supplies of rare earth minerals. Instead, he came back with vague promises and no firm deals. Behind closed doors, emerging economies made it clear they're not waiting on Washington anymore. Nations that once relied on the U.S. as the financial backstop of the world are now building parallel systems. In Southeast Asia, Africa, and the Middle East, central banks are transacting more with the Chinese yuan, less with the dollar. Trade platforms in Dubai, Lagos, and Singapore are accelerating deals that bypass U.S. banks entirely. This quiet exodus from the dollar doesn't come with press conferences. No one is making grand declarations. But the trend is undeniable. It's being called stealth de-dollarization. And it's not just happening in places the US sees as rivals. France, Germany, and Saudi Arabia, all longtime partners, have started using euros and yuan to settle major energy and infrastructure deals. Even India, a country historically non-aligned, is taking steps to move away from dollar dependency. Central banks are buying gold at the fastest pace in over 50 years. They're diversifying, hedging, preparing for a future where the US is no longer the world's financial anchor. And the market is reacting. The US dollar index, which measures the dollar's strength against other major currencies, has dropped from 104 to 100 in just a few weeks. That 4% dip may seem small, but in the world of currencies, it's a sign of instability, a signal that investors are beginning to question whether the dollar's dominance is still guaranteed. For decades, the dollar was the safe haven. In times of crisis, money flowed into the United States, not out. But now, with inflation stubbornly high, interest rates climbing, and bond auctions failing, that faith is being tested, and the cracks are spreading. Shipping through the port of Los Angeles, one of America's largest trade gateways, is down 23% since the start of the year. Retail inventories are backing up. Imports are slowing. A leaked Commerce Department report warned that the sudden tariff rollback in May wasn't a calculated move. It was a last-ditch effort to prevent a broader retail collapse. And still, China didn't blink. After Trump's sudden announcement slashing tariffs from 145% to 80%, Beijing offered nothing in return. No agreement, no concessions, just silence, again. But behind that silence was a message. The United States no longer holds leverage. In fact, China escalated. It tightened export restrictions on rare earth metals, banned the sale of critical tech components to U.S. firms, and expanded deals with BRICS nations and Southeast Asian partners. Instead of engaging, it reinforced its position. In the past, a gesture from Washington would lead to months of negotiation, compromise, and press statements. Not this time. This time, China walked away, and others followed. Brazil signed a new bilateral trade agreement with India, denominated entirely in local currencies. Turkey moved a quarter of its central bank reserves into gold and Chinese yuan. Indonesia began piloting a cross-border payment system that excludes both the dollar and the euro. All these shifts are subtle but coordinated, and they show one truth: the world is moving on. Even the global financial architecture is changing. China's digital yuan is now used in cross-border transactions across 30 countries. Its payment platforms are cutting U.S. banks out of the equation. That means fewer fees flowing into Wall Street, fewer dollars being recycled into U.S. bonds, and fewer tools for Washington to control global money movement. Back home, the Fed is caught in a bind. It wants to fight inflation, but it also knows higher interest rates make the debt crisis worse. Every 1% increase in rates adds hundreds of billions to the government's annual borrowing cost. But cutting rates risks unleashing inflation again, just like during the Biden-era stimulus. The last time the Fed printed trillions to cover federal spending, inflation exploded past 9%. Rent, groceries, fuel, everything got more expensive. The middle class suffered, and trust in the US dollar, both at home and abroad, began to erode. Now, faced with another potential debt crisis, the Fed may have to print again, but this time the consequences could be even more severe. We're talking about potential hyperinflation, a dollar crisis. The kind of event that turns a global power into just another debtor nation, and all of this is happening faster than most Americans realize. What used to be economic theory is now a daily reality. The world is already building Plan B, parallel markets, new alliances, digital currencies not tied to Washington, and it's doing it without waiting for US permission. Meanwhile, American leadership is stuck reacting instead of leading, announcing policy shifts by surprise, sending officials abroad in panic mode, downplaying inflation numbers while shelves empty and borrowing costs soar. There's still time to respond, still a window to restore confidence. But that window is shrinking. If the next bond auction fails, if investors demand even higher returns or refuse to buy entirely, the spiral will tighten. Interest costs will skyrocket, programs will face cuts, and the Fed will be forced to choose between printing money or triggering a default. Neither option restores trust. At the root of all this is a basic truth. Trust is the currency the US needs most right now. Not dollars, not tariffs, not bravado. Trust from lenders, trust from allies, trust from the markets. And that trust is fading. America spent decades building a financial empire. Now that empire is being tested, not by war or invasion, but by doubt. Doubt in leadership, doubt in stability, doubt in the future. The rest of the world isn't waiting around to see how it ends. They're making other plans. The global shift away from the US dollar isn't just an economic trend anymore. It's now a systemic challenge. And for the first time in a generation, America is on the back foot. Not because of war or natural disaster, but because of a crisis it created for itself. The warning signs have been flashing for years. Warnings from economists, former Treasury officials, even global financial leaders. But they were either ignored or brushed aside. Now, those warnings have materialized. The US finds itself with record debt, a bond market wobbling, rising interest rates, a Federal Reserve trapped between inflation and insolvency, and an international community that's increasingly unwilling to bankroll America's habits. The biggest risk isn't just economic, it's psychological. Once global trust in the US financial system breaks, it won't be easy to put back together. That trust has always been America's real power, more than its military, more than its markets. The belief that the US could always pay its bills, always lead in a crisis, and always recover. But when the world starts to think, maybe not, that belief dies quietly, and often permanently. This is how empires fade. The dollar has long been the world's reserve currency, the backbone of trade, investment, and global finance. Countries hold dollars in their central banks because they trust it. Oil is priced in dollars. International deals are settled in dollars. The US gets to print the world's money, and the benefits have been massive. It has allowed America to run huge deficits without collapse. It has supported the military, social programs, and consumer lifestyles that would otherwise be unsustainable. But all of this relies on one assumption, that other countries will keep accepting those dollars. Keep buying those bonds. Keep playing along. That assumption is now being tested. In private conversations, even America's closest partners are rethinking their strategies. Diplomats from Singapore, South Korea, and even the UAE have quietly expressed concern over US unpredictability. Not just economic, political too. The tariffs, the sudden reversals, the lack of long-term vision. They're asking the same questions investors are. Is this still the safest place to put our money? If the answer continues to shift from yes to maybe, and then to no, the consequences won't be gradual, they'll be fast, deep, and wide. Here's what that could look like. Bond demand collapses. With fewer buyers, interest rates surge even further. The cost of borrowing spirals out of control. The government is forced to cut programs or print more money. The dollar weakens. Import prices rise, making everything from fuel to food more expensive. Inflation becomes harder to manage. Wages don't keep up. Pensions and savings erode. As bond values fall and volatility rises, retirement accounts and savings lose value. Middle-class security begins to unravel. Capital flees. Investors, both domestic and foreign, start moving money to safer places. Gold, Bitcoin, foreign currencies. The outflow creates instability in markets and banks. Global trade bypasses the U.S. new payment systems, and bilateral deals allow countries to work around the dollar. That means fewer fees for American banks, fewer strategic advantages, less influence. All of this could happen slowly, or suddenly. But make no mistake, the trajectory is already underway. Back in Washington, there's growing pressure to act, to stabilize bond markets, to restore faith in U.S. leadership. But political will is fractured. The tariff cut in May was met with backlash from Trump's own base. Some called it surrender. Others saw it as a betrayal of economic nationalism. In Congress, there's no consensus on how to fix the debt spiral. Some want austerity, deep spending cuts. Others want more stimulus, hoping growth will bail the country out. Meanwhile, the Fed is isolated, trying to thread the needle with rate tweaks and cautious language. But the problem isn't technical. It's foundational. The United States has reached the point where more borrowing isn't a solution. It's the problem. And unless this is acknowledged honestly, every policy decision will be another bandage on a broken system. Overseas, rivals are watching and preparing. China continues to secure natural resources, sign energy deals, and build digital finance alternatives. Russia is expanding trade in rubles and yuan. BRICS is growing in both influence and ambition. Even African nations are exploring regional currencies and gold-backed reserves. They're not trying to destroy the dollar. They're just building a future where they don't need it. That alone changes everything. To most Americans, none of this feels immediate. The stores are still open, the banks still operate, the headlines still bounce between scandal and spectacle. But under the surface, the foundation is cracking. What's missing is urgency, not panic, just clarity. Clarity that the financial rules are changing, that United States dominance is no longer automatic, and that trust, both domestic and international, must be earned again. This is the cost of decades of short-term thinking, of assuming that deficits don't matter, that tariffs can fix trade, that allies will always wait, and that leadership means never having to adjust. That era is over. The next steps will determine whether the United States adapts or falls behind. So what needs to happen? First, Washington must acknowledge the seriousness of the problem, that the bond market, the dollar, and international trust cannot be taken for granted, that silence from foreign governments isn't indifference, it's strategy. Second, a real plan is needed, one that combines fiscal discipline with smart diplomacy, trade policies that strengthen ties, not isolate, debt management that prioritizes sustainability over politics, and leadership that reassures both markets and allies. Third, communication must change. No more surprise announcements, no more contradictions. Investors need stability, partners need clarity, citizens need truth. Because if the world thinks the United States doesn't have a handle on its own finances, it will stop treating it like the center of the global system. And once that role is lost, it doesn't come back easily. We are not witnessing a crash. We are witnessing a slow exit. The world is walking away from American financial leadership, step by step, trade by trade, deal by deal. This isn't speculation. This is data, movement, strategy, and it's happening right now. The United States still has the tools to lead, the size, the innovation, the institutions. But none of that matters without trust. And trust must be rebuilt. One policy, one promise, one bond auction at a time. The final warning is here. Not shouted, not televised, just written in numbers and echoed in silence. The rest of the world is watching. What's unfolding isn't just about numbers or bond auctions, it's about trust, and whether the world still believes in America's ability to lead economically. The headlines may talk about tariffs and inflation, but the deeper story is one of credibility. A financial empire built on confidence is now facing doubt, not from enemies, but from former allies, global markets, and even its own institutions. The silence from Beijing, the sell-offs from Japan, the new trade routes avoiding the dollar. These aren't coincidences, they're signals. And the longer Washington pretends this is just another market cycle, the harder the fall may become. The U.S. has a choice to make. Rebuild trust and realign with the global reality, or continue down the path of reactive policy and political theater. But make no mistake, the world is already moving. The dollar is no longer the default. The U.S. is no longer untouchable. And the next financial rupture won't come with warning sirens. It will come with a whimper and a headline the morning after. Now we want to hear from you. Do you think the U.S. can restore global trust before it's too late? Are we witnessing a temporary shakeup or the beginning of something irreversible? Drop your thoughts in the comments below. We read every single one. If you found value in this report, Support the work by hitting the like button. It tells the platform that this information matters. Subscribe to the channel so you never miss a breakdown like this. We're committed to clear, fact-driven reporting in a world of noise. Thank you for watching, and stay informed. The world is changing fast. We'll be here to walk you through every step.